Well, this is the introductory reading to the fixed income section. So they're just laying some groundwork for issues. We're going to talk about leverage. It's an important topic. It's going to have carryover as we go along. Leverage is using other people's money. There's a great movie with Danny DeVito. He said, how do you get rich? You use other people's money. It's a good principle to think in mind. That's what leverage is about. If I can borrow money, let's say I can borrow money at 3% and I can invest it and I can earn 5%, I'm going to eventually become very, very rich. I just need to use lots of leverage, do this with lots of money, and I'll become immensely successful. If I had a stable upward sloping yield, let's jump ahead to something we're going to be talking about later. We're going to come back to this issue. Where are we going to go with it? Suppose the yield curve is stable, and suppose it's upward sloping. Borrow money at the short end, invest your money at the long end, do a lot of this, and you're going to be able to retire. You're going to become immensely successful. Very important the yield curve be stable. If short-term rates start to go up, you borrowed short-term, your borrowing costs will start to rise. If long-term rates go up, that's even worse. When rates go up, the value of your position loses, and you could have negative total return. You're not earning 5% anymore. So leverage can also work against you. Leverage is a magnifier. Now, they've written an equation for how to calculate the return of a leveraged portfolio. It is an important one to know because it helps you understand something. What is your cost of carry? Cost of carry is referring to what's the differential between what you earn on the money you borrow versus what you pay for the money you borrow. As long as that differential is a positive, leverage will be beneficial. But if it flips and becomes a negative differential, then the leverage will start to work against you. As long as the differential is positive, as long as there's positive cost of carry, the more you borrow in relation to the initial investor's equity you started with. What did you start with in capital before you borrowed any money? That's VE. How much did you go out and borrow? How much did you leverage it up? As long as the cost of carry is positive, the more you leverage it up, the more you're adding to the base rate of return on the assets, the more you're enhancing the portfolio's return. But of course, if this becomes negative cost of carry, the more you've leveraged up, the worse it is. And boy, if the cost of carry becomes too negative and you use too much leverage, you could actually end up with a negative rate of return on your portfolio. You could start to lose everything you have. So leverage is a two-way street. And we can already see where the shape of the yield curve will ultimately come important in discussions about whether to leverage. And we can already, I hope, see why stability of what's going to happen going forward will be important to what we're going to do in this. Basic formula, that cost of carry is critical. If it is negative, that will start to harm the rate of return on the portfolio. We need to avoid that situation. But there's also a more subtle issue associated with this. When you borrow, normally you have to put up collateral. You also have to think about it from the point of view of the person that lent you money. Now, an interesting thing about lenders and borrowers, if you need money, or rather, if you want money, but you don't really need it because you're in great shape, lots of people will lend. But if you get into the point where you're in distress and you really need it, that's when they don't want to lend. Or if they've lent you money, they want to grab their money back. So if you start to experience negative cost of carry and the value of your portfolio is starting to drop because you're starting to earn negative rates of return, you may find your lenders are trying to immediately recover the funds. And if you have to start liquidating your positions to pay back the borrowed money, and you're liquidating when they're down in value, you can see how that can be a problem. And it can also spread. It can become a system-wide problem. It can lead to a market collapse. Let's say many portfolios are leveraged. The market turns against them. There are forced liquidations to pay off the debt. but forced liquidations drive down prices of assets. You can trigger market collapses. So leveraging can be a plus or a minus at the level of the individual portfolio. At the market level, it can also contribute to serious problems if the difficulties become widespread. Good thing to be aware of. Explicit leverage. Go borrow the money. A common way to do that is the repurchase agreement. You're using your own assets, or maybe even the assets you bought on credit, as collateral to support the amount of money you're borrowing. That is what a repo is. Repurchase agreements are often called a sale. That's a superficial understanding of what's going on. So let's think about it as a diagram. Suppose you're party A. You want to borrow money. So you take assets in the portfolio, you deliver them to a lender, and they lend you money. That is the initiation of a repurchase agreement. Now, normally what you deliver has to have a market value in excess of the cash received. The lender wants to protect themselves. The riskier you are, or the more questionable your loan characteristics, the greater the amount of collateral they will demand. That is not a repurchase agreement, because simultaneously in a repurchase agreement, you are agreeing at its future date that you will repay the money borrowed, the principal, and pay interest on the principal, and you will receive back your collateral. So when you deliver the collateral, while we call it a sale of the asset, it's not a sale of the asset. The asset is just collateral for a loan transaction. It's really still your asset, and you're going to receive it back when the repo is closed. In most repos, there's a specified date when the repo will reverse. You can have open-ended repos that go till canceled, but repos are normally done for a specified period, and most of them are overnight or till the next business day, over the weekend, or over the 3-day weekend if they're a holiday. That's the most common repo. But you can do them as a term repo for longer periods, but they're generally relatively short in term. How do you calculate the interest? There's a computation. What is the principal amount, the cash? What was the repo rate? And it's treated as a 360-day year calculation. Can I do the same thing? What does borrowing do? It enhances and leverages return. Therefore, buying a futures contracts on bonds is equivalent to buying the bonds and leveraging it by borrowing money. Why do I say that? If I buy the bonds and leverage it by borrowing money and interest rates drop, the value of the bonds I bought go up and I leverage up my rate of return. If I buy a futures contract and interest rates go down, the value of the contract goes up, leveraging the rate of return in my portfolio. So the mechanism of futures contract is very different than a repo transaction, but it's having the same economic concept. We can think about the degree of leverage as what is the notional amount of the value the bonds control, and how much money did I have to post as margin? Now, the margin postings are usually very minimal. They're very, very small, so the amount of leverage is very, very large. In later, as we get into actually working with this concept, we're actually going to ignore the margin because it's so small, it's generally really unimportant to understanding the use of contracts. When we get into derivatives and some of the fixed income sections where we talk about buying contracts, we just talk about buy the contracts, increase the rate of return if interest rates fall, and we don't even talk about the margin amount because, again, it's so small as to be inconsequential. So here's an example of an equation. It's true, but it's actually a distractor. It doesn't have anything to do with anything that's important. Now, that didn't say every equation is useless. How do I calculate the rate of return on a leveraged portfolio? That's what I need to know. Or I could use a swap. Suppose I've got a portfolio, I just sign a contract. Let's say that I sign a contract to pay a fixed or a floating interest rate. That's like I borrowed the money. Here's the terms of what I'm going to pay. And in exchange, I will receive whatever it is I want to specify I want to receive. As long as this rate of return is higher than what I'm paying out, I have the same consequences as leverage. I will magnify my upside. So futures or swaps are another way to create the results of leveraging without formally borrowing money. Remember, OTC normally didn't include mark-to-market or margin, but they are pointing out the markets are evolving. Often those are written in as requirements, even for over-the-counter transactions. Now, they also bring up the idea of what is the repo market? We've looked at that, as opposed to securities lending. Let me back up for a second. So we look at the repo transaction. When I look at a securities lending transaction, it looks very, very similar overall, but the motivation is different. So in form, they seem to be the same thing, but in intent and motivation behind why they're being done, they're actually very different. So let's take a look now at what is securities lending, because it's becoming a more important part of the marketplace. Again, it looks like repo, but the motivation's different. Repo, I want to borrow money. I want to leverage the portfolio. Securities lending, I want to borrow the securities. When you short sell something, generally you must be able to immediately deliver what you shorted. But a short sale means selling something you don't own. How can you immediately deliver on a short sale something you don't have? You go borrow the item. So we look at the standard repo. We see it's a receipt of cash. The collateral is delivered as collateral. Those are securities. But let's look at it from Party B's perspective. They're receiving certain kinds of collateral. From their perspective, it's like they're borrowing securities, and they will ultimately have to return those securities. So looking at a repo from a different perspective, we can think of it about as being securities lending. We're lending the collateral to somebody. Now, the difference would be, unlike a repo where we want money and we just deliver collateral, and the lender doesn't particularly care about what collateral. They want to know the quality and the amount of collateral. They don't really care a lot about which particular items we gave them as collateral. With securities lending, they're probably going to say, these are the items we want to receive. They're looking for very particular securities to borrow, typically to support a short sale that they want to execute. So, different motivation. Because they're supporting a short sale, we usually don't set a termination date on a securities lending transaction. With a repo, we normally do. With securities lending, it's normally open-ended. It will have to be closed, but whenever either counterparty decides it, they can call for closing the transaction. But we generally don't set a termination date because of the motivation. Somebody wanted to borrow very particular securities. And of course, the more they want those securities, the more they want us to cooperate. So what can they do? Lower the interest rate they're going to charge, or maybe even pay us a fee. Give us cash and also pay us a fee for being willing to deliver specific securities. So you can begin to see the relationship, but also why the motivation is different. The last thing they have in this module is a little quick discussion about taxation issues. And the best answer is they don't tell you anything you don't know from study session 4. And everything they tell you, they don't do it as well. You'd probably be better off to only focus on study session 4, where we really covered it. And an overview, and again, what we learned there, the exact tax laws, that is not what the CFA curriculum tests or teaches. If you need to know something about exact tax laws, it might be built into the question, and then you know how to deal with the information provided. This would not affect some types of investors if they're tax exempt. Generalizations in most countries around the world, when income is received, taxes are due. Why don't I buy zero coupon bonds? No income's coming in. I won't have to pay any taxes till the bond comes due. Nice idea, but unfortunately, most tax codes around the world say if you buy a zero coupon bond, they will impute an income each period and tax you on it as if you'd been receiving cash. So many taxable investors generally don't want to buy zero coupon bonds. Most of them tend to be purchased in tax-exempt situations. What about gains? Generally, the tax is imposed when it's realized, not because of a hypothetical change in market value. Generally, capital gains are taxed at lower rates, and generally taxable losses can be used to offset. We did all of those types of things back in study session 4 in much, much more detail. So you're not really learning anything new. Your reading also includes a short section letting you know the basic principles behind taxation of mutual funds or any other type of pooled vehicle where individual investors place their money in it, it's pooled together, and it's invested. Generally, the vehicle itself, the mutual fund, is not a taxable entity. The underlying owners of shares in that portfolio are taxed on what's happened, so the fund would pass those things through. So let's say that you invest in a bond fund. It earns interest on the underlying assets. You would have a pro rata share in that interest. It would be reported to you, the investor, or to any investor, and that interest would go on their tax return. It doesn't matter whether the interest is passed through. It doesn't matter whether they withdraw it. It doesn't matter if they reinvest the interest earned in more shares. The interest earned by the fund, pro rata, belongs to the underlying investors, and they're taxed on it. In many cases, gains, realized gains or losses would work the same through, and that would be called pass-through accounting. But there is some variation in the taxation of gains. And again, it doesn't have to be a gain. It could be a loss. Loss it would also might be passed through. So pass-through taxation is one methodology by which funds deal with it, but it really depends on the laws of the country. The United States would be an example of a country where it works that way. You notice I penciled in an example. Let's say that you're an investor and you buy into a fund at a price of $100 a unit. So I'm denoting as T0. However, the fund had already existed, and let's say it had purchased an asset, and let's say, to keep it simple, there's only one asset in the fund. So you buy in, you pay $100 a share because that's the current market value of the asset. But the fund has been in existence. Somebody else had put money in, they'd withdrawn, you're buying in, and the asset itself had been bought at $80 a share within the fund. Then, after you buy in, the value of the asset and the value of the fund declines to 95. And if that's all that happens, there's no taxing event. You haven't sold your units. But suppose the underlying asset within the fund is sold within the fund at 95. Now, you bought in 100. The value of the fund has dropped to 95. And the fund sells the asset, deciding to rebalance the assets in the portfolio. Because the asset within the fund was sold, there is a realized gain from historical cost basis of 80 to 95, and that is passed through to you, the investor. So any of you who are invest in mutual funds, you may have come across this if you're, for instance, in the United States or other countries that use this method. You can buy units of a fund. You could see the value of the asset, the fund, drop during the period, yet realized gains are reported to you based on sales that were made within the underlying fund itself, and you have to pay taxes on those gains. Even though you actually saw your unit unit value drop during the period. That's a consequence of pass-through taxation. By the way, that also means you should adjust the cost basis of your holding so that you won't have to pay taxes again on a gain when you sell your units. But that's beyond what the Institute's going into. They're just pointing out the gains or losses taken within the fund are reported out to you. They go on your tax return, and that's independent of what's happening to the unit value of the fund period by period. That's one method of taxation. The other method is deferred taxation. Again, you buy in, the fund realizes some gains or losses, no tax consequences to you until you sell your units. When you sell your units of the fund, where do you sell it? What did you pay for the units? That determines your gain or loss. The UK is an example used as that deferred taxation methodologies. So two different approaches. Let me just add a caveat. From my experience, this is not a guarantee. The Institute, we've never seen them asking questions about what's the law in the following country. Even though they may give examples of that, that's to illustrate underlying principles. We have not seen them ask questions on the CFA exam where you're supposed to memorize the rules of specific countries. What you're more likely is maybe there's a question. In the course of the question, they explain to you the method being used in that country, and then you have to draw some conclusion or make a calculation or do something where you have to understand the implications of what the question itself says. So you're seeing there's a variety of methodologies, and you're familiar with basic taxation principles. Then you wait and see what the specifics of the question. And what is the question? You'll be able to answer it if you have the underlying knowledge.